We're now on segment 3 of session 12. We're going to talk about break-even analysis. And okay, so what this is going to teach us is how much of your product or service do you have to produce before you make a profit. This is a critical piece of information. It's going to help you know what's your target every day, every week, every month. What does that look like? And for planning purposes, include this in your plan. By including this in your plan, it will demonstrate that you understand what you have to do to be profitable. Okay, so even if you're only doing your own plan for your own purposes, you're just going to be the only person that reads it and uses it, this is still extremely helpful. If it's going to be where there's other people involved, this is going to clearly demonstrate that you know what the target is and what you've got to do so that the other people, the other interested parties in the business are going to be able to achieve what they want from the business as well. So a break-even analysis predicts the sales volume at a given price required to recover the total costs. So in other words, it's the dividing line between operating at a loss and operating at a profit. So obviously we want to be able to operate at a profit. So there's two categories of expenses that we have to be aware of. Okay, so I don't mean like the line item expenses we were talking about before, but the expenses related to producing your product will get grouped into one of two areas, either fixed expenses, which are the expenses which do not change based upon the sales volume of production. I'll give you some examples in a second. The other is variable expenses. These are the expenses which do change based upon the sales volume or production volume. Okay, so some examples of fixed expenses or rent or mortgage. If you've got a mortgage or rent, it doesn't matter whether you sell 1 or 1,000,000 that month, you still get the rent or mortgage amount is fixed. So it stays the same regardless of volume. Many of your insurances, not all of them, but many of your insurances will be fixed and they aren't tied to production. Okay, loan payments of any kind, if you've got equipment or things like that, the loan payment is what the loan payment is. Your phone bill is what your phone bill is, and yet maybe you're going to, this is presuming you're on a plan that it's a fixed amount per month. So that little disclaimer there. Variable expenses, the more you sell and manufacture, presumably the more raw materials you're going to need, the more labor that's going to be involved, the more packaging you're going to need, and the more equipment maintenance that you're going to have if you've got a high volume of production. So expressed as a formula, okay, so this is why we have to do the fixed and variable costs. On the top, so the break-even sales is the fixed cost divided by the number 1 minus your variable costs. And this is the variable costs expressed as a percentage or a decimal. You'll see what I mean in a second. Now, you very well may need your accountant to help you with this, okay? And that's fine. I want you to be aware that this formula exists so that you can do the calculation to include it in your business plan. So here's an example. Okay, if we have, and here's the formula, break-even analysis. This isn't break minus even. This is break-even sales equals fixed costs divided by 1 minus your variable costs. So in the first example, I've got 3 examples here to show you because I want to illustrate how the amount of sales you have to generate can vary drastically based upon your variable costs. So your variable costs are in part what your material costs are. If you're not getting a good price on your materials, it will show up right here. So in this scenario, let's say that the fixed costs are $1,500 a month, okay? So whether they sell a ton or sell next to nothing or sell nothing, their costs are $1,500 a month. Their variable costs, the cost to produce that product, are $25. Their variable costs are 25%, so it's 1 minus 25%. So it's 25% of the sales price. Now, so if you do the math, 1 minus 25% equals 75% or 0.75. 75% expressed as a decimal is 0.75. If you do the math, the break-even line is $2,000. They sell less than $2,000, they lost money that month. They sell more than $2,000 that month, they made money that month. And these calculations were done presuming a monthly basis. Now, let's look at the next example. The formula stays the same. Our fixed expenses still the same, $1,500 a month. But now our variable expenses are half of the sales price, 50% of the sales price. So we do the math, 1 minus 50% equals, expressed as a decimal, 0.50. So if you do the math there, the break-even line is now $3,000. Okay, so keep in mind, fixed costs didn't change. Our materials and labor are more here. It's half the purchase price rather than 25%. And so now our break-even is up to $3,000, 50% more sales. Now, let's look at the next example. Still, fixed expenses, $1,500 a month. Variable expenses now are 75% of the sales price. We do the math. That means, so 1 minus 75% is 25%, or 0.25, expressed as a decimal. Now look at our dividing line for profit and loss. 6 G's. Our break even went from 2,000 to 3,000 to 6,000. So you got to do triple the sales. Okay? Now, this is a mistake that a lot of people make. They're like, but wait, I'm making 25% off every single thing that I sell. I agree. But now you got to sell $6,000 worth instead of $2,000 worth. Now, maybe you can, maybe you can't. Obviously, this is part of the exercise in becoming a business person is, do you have something that you can, now, can you raise the price? Or, because remember, only 2 solutions. That's it. 2 solutions to any financial problem. Make more, spend less. So can you raise the price? Can you lower the expenses? Or do you just have to generate more sales? Okay. Those are the things that we can do. Okay. Now you've seen break-even analysis. Again, you're probably going to need the help of an accountant to do this. That's fine. Enlist their help. And it's going to have to be somebody that's knowledgeable with cost accounting. Not any accountant is going to know how to do this for you. They learned the formula when they were going through college, but they may not, if they're not used to dealing with this, it's not going to be something that their familiarity is there with. So you've got to get somebody that's used to dealing with what's known as managerial accounting. Okay. Now we're going to go back, we're going to move forward to the next segment, and we are going to revisit the executive summary and then talk about the next steps.